Hello from New York, where markets have closed after the January policy meeting of the Federal Reserve. Investors have encountered a central bank stuck on autopilot. The US Fed issued a circumspect policy statement on Wednesday. It confirmed an expected $10 billion reduction in its monthly bond purchases to now $65 billion, and it was marked by no follow-up press conference for the final meeting chaired by Bernanke. For markets nearing the end of January, the FOMC's anodyne statement failed to arrest what has been a rough start to the year for equities, and we've also seen a surprising rally in Treasury debt led by long-dated bonds. On Wednesday, the S&P 500 extended its losses and has now fallen 4% during January, on course for its first negative month since August. Meanwhile, news of less bond buying from the Fed failed to arrest the 10-year Treasury yield from falling below 2.68%. Its lowest level since November, and marking a substantial drop from its peak of 3.03% at the start of the year. The divergence between stocks and bonds may well be a temporary hangover in the wake of last year's stellar performance by equities and the sharp rise in Treasury yields. A pickup in the economy marked by stronger jobs growth that facilitates a steady tapering from the Fed is widely viewed as resulting in stocks ultimately outperforming bonds in 2014. The big wild card in all of this, however, and a major catalyst behind this month's moves in equities and bonds, is the spectre of financial contagion from emerging markets. This week we've seen emergency rate hikes by central banks in Turkey, South Africa and India. And the silence from the Fed about emerging market stress is not surprising. In the past, the FOMC has referenced strains in global financial markets in their statements, but only when it has threatened US growth prospects or financial institutions, such as we saw in 2012 when the Eurozone crisis escalated. Before the next FOMC meeting in March, Janet Yellen, the incoming Fed chairwoman, will address Congress in February. It leaves the central bank on autopilot for some time as investors watch data, earnings, and gauge whether signs of financial contagion emerge from emerging markets. For now, the central bank remains set on its flight plan of trimming bond purchases in clips of $10 billion at each meeting. But at some point, the central bank may well have to flick the switch and reclaim the controls should its flight plan encounter turbulence.